Welcome back to another episode of Real Estate Investing in New York with me, Christina Kremidas. In this episode, we have an incredible guest on with me, highly anticipated. She actually was on my show a couple of years ago, and she is back. We have Yvette Sadovoy.
Thank you. I'm so excited to be back. Thank you for having me, Christina.
Yeah,
I'm so excited to be here. I'm so excited. I love our chats.
So stay tuned. We're covering everything you need to know about how to make your real estate property work for you tax-wise. Yvette is a tax preparer and strategist. She does all my personal work, and I recommend her to my clients all the time. So stay tuned. We're covering everything here. This is Real Estate Investing in New York with Christina Kremidas, helping you achieve a future of financial success by making intelligent real estate investment decisions today. Thank you guys for being here. I'm so excited to have this wealth of knowledge here with us today. Yvette, welcome.
You're so sweet. Thank you for having me again. I'm so excited.
The amount of info that we're going to cover in a short period of time today is amazing, and it's going to be so helpful for so many people. So to our listeners, if you have an investment property, or if you're interested in investment property, or if you own any type of real estate asset in the city, or if you're considering it, you are going to be very interested in what Yvette has to tell us today. Even if it's just a primary residence, she is going to be giving us all of the tips and tricks as to how you can make your property work for you on your taxes. So what do you have to give us? Where should we start?
This is actually my favorite topic because I think people generally don't really underestimate the value of, or rather the contribution of family, generational wealth building. And everyone thinks about just stocks and investments, in that type of medium in their portfolio. No one really, or many people aren't able to break into the real estate, to kind of, not to say like monopoly it, but you know what I mean? To kind of, own multiple properties. I have a few clients that were able to do that over time with strategic saving and tax planning and so forth. And it's a huge game changer, especially when you buy a property in right at the right time, at the right market with the right rate, and you actually hold on to it. The value goes up insanely, right? And then of course, the better the purchase, which is what you're here for, right? So you help the client get that great deal. And then once they start implementing the investment part of it, right, and they start profiting off, obviously you can profit just by charging the rent. But in general, there are so many ways that you can save money by having an investment property, right? We can start off by talking about even just type of deductions, right? Or let's actually start from the beginning, right? So the most common mistake that I see people make is now everyone's renting their properties on Airbnb, VRBO, and let's say you rent it out and you gross $15,000 and Airbnb charged you $1,000 for fees and you got $14,000. People will report $14,000 as income and then go ahead and write off the rest of their expenses. And this always gets flagged by the IRS because you didn't actually make 14, you made 15, even though you paid out the $1,000 in fees. So they'll always get a letter saying that your tax return doesn't match with the IRS records because Airbnb, VRBO, they issue 1099s. So it matches. Right? And it's something so silly, but all you have to do is report on the top, oh, I earned $15,000, and then as a part of all of your deductions, you deduct that $1,000 fee, right? So you're still deducting it, but you're just putting it in the wrong line.
Right.
But that one little line, now you have to deal with IRS letters, now you have to deal with state letters, now you have to call them, now you have to amend the return because you don't want to pay them this fee because you didn't really make the $15,000, you made the $14,000.
Can that trigger an audit?
By itself, probably not, right? Usually it's one of those things where you'll just get a letter and they'll say your records don't match our records. Reply back with whatever your opinion is, and either you made a mistake or you just amend the return and refile it and say, okay, sorry, my bad. Right. I fixed it.
Yeah.
But it's just annoying to deal with, right? You don't have to go back and redo things, and then your accountant will charge you more for something silly, even though actually this is the accountant's responsibility to know this. So be clear about that. But on top of that, right, when you're talking about deductions for the company, for the property, the majority of deductions that people forget, ironically, are HOA fees. I don't know how, you're paying this monthly maintenance on a condo or a townhouse, right? And they forget. That's a common one. Depreciation, which is a huge one. Everyone thinks that you're just going to write off your mortgage payment. Like, oh, if my mortgage is $3,000, I charge rent $2,000, then, I make $5,000, I make a profit of $2,000. But in reality, you still have to account for depreciation. So the best thing about rental properties is that on paper, almost always you lose money, right? Because even though you're profiting on top of the mortgage, you're thinking, oh, well, if my monthly payment is $3,000 and I'm charging $5,000, I make $2,000. But on paper, you still have to count depreciation. So when you're talking about a property that's worth a couple $100,000 a year, that's worth a couple $100,000 when you purchase it, depreciation could easily be anywhere from $5,000 to $10,000 to $15,000 a year.
Right.
So that gets added on as a deduction every year.
Is depreciation, is it a percentage of the property's purchase price, or?
No, it gradually it prorates over the lifetime of the property. So if it's a condo,
so
it
it has to do
depreciates
with
over
the-
27 years. And if it's a house, it depreciates over 39 years.
Oh, so it's the property value divided by those numbers.
Not the property value, the property type. So if it's a condo or an apartment or a co-op, it depreciates over 27 years. So for example, if you bought it for 100,000, you take 100 divided by 27, and that's your yearly depreciation.
Okay.
And if it's a house, it's 39 years. So it depreciates like over time more than that. So you have that, right? Another big thing that people forget when they own a house is pool maintenance.
Oh.
You can deduct pool maintenance.
Like for your pool?
Yeah, for your pool. Also, this is also, by the way, deductible for home office if you're self-employed. So for all the real estate agents listening, if they have a home with a pool, you can deduct as part of the home office the pool expenses. Everything, all home expenses.
That's so interesting. Yeah, I feel like I know that you know everything when it comes to I feel like you know everything when it comes to deductions, and half the time especially when we were first starting to work together, you would look at my list of deductions and you're like, where are all of your deductions?
Yeah,
I'm like, I sent them to you. What are you talking about? Yeah. And you're like, do you even know what you're missing here? And I thought that was incredible. So we'll save some. We are going to cover, if you're a real estate agent, we are going to cover on this episode tips and tricks for you to, of course, have your taxes be not lessened, but I don't want to say that, but
it's optimized.
Right.
I like the word optimized.
Yeah, how you can optimize your own personal taxes, because Yvette is excellent at working with real estate agents to properly help them complete their tax returns. So that is coming towards the end. Okay, perfect. Yeah. So for investment property owners, we talked about write-offs. Anything else that we need to cover on that?
So when we talk about property write-offs, right, you can also deduct commuting or traveling to and from this property, right? Because you have to go check on it. You have to go talk to your tenant, right? So at least an active owner, right, rental owner will come by at least once a month, right? Just at the very least to see how everything's going, make sure everything's okay, look around outside the property, make sure there are no issues, just do a check-in. So that is business deductible. That's a deductible expense to the rental property. So you can, especially if it's in a different state, we have a lot of clients who, and I'm sure you do too, that have, in Florida or somewhere warmer. So if you travel there to check on the property. Oh,
that's interesting when you think about an investment property that's not in your current market where you live.
Yeah, of course. And a lot of people do that, right?
Flights.
Like they want, flights, hotels, food while you're traveling.
That's big.
So that can also add up to a good amount, especially a lot of people, especially like if in the warmer states, people tend to travel there more often. So as long as if you have a property in Miami and you're planning to do a weekend there, stop in, check on your property, talk to your tenant, see if anything needs to be fixed, replaced, spend some time doing that, an hour a day for your long weekend, and that whole weekend is deductible.
There you go. Guys, it's been like 4 minutes so far, if that.
Like go screw something in.
The amount of
go fix a light bulb in the rental property.
Yes, the amount of great info is already phenomenal. I'm so excited.
I'm telling you, it's great. People don't think about these things, but it's
right.
I always say this, and I said this to you from the beginning, right? When we talk about tax deductions, it's never about finding those big ticket items, because they're very few and in between, right? Yes, your home office and your car and your cell phone, everybody knows those, right? Those cookie cutter ones. But there are only so many of them, right? Everything else is in the small pennies that you spend every day, right? Like the driving to, the miles driving to the rental, the plants that you bought for the rental, right? For the landscaping, the seeds, if you a lot of times people will say, oh, I don't have landscaping fees, I do it myself. Like, okay, but you bought plants, right? You bought seeds, you bought supplies.
Right.
That counts. That's landscaping expenses.
Right. Talk to us about vacancy. How is that accounted for? Is it just...
Not much you can do, honestly. It's basically, it ends up just calculating as a loss. So for example, if you charge $1,000 a month and you had 2 months vacant, but you still have to pay for expenses, right? You still have to pay your rent or the mortgage and the utilities in that unit. So those expenses will still count. You'll still count your expenses for the whole year. Less income, but more expenses. So your net is either net zero or in a negative.
Okay.
Because you didn't have enough. Like every owner, when they think about their rental income, they know that they need to have X amount of income coming in every month for the full year in order to break even or to profit or, whatever in between. So there's no between, but whatever. I think you're just profiting or you're not.
Right.
But to minimize that, right. So there's nothing you can do about it, unfortunately. But the only caveat is to rental properties is that it can be vacant and that's fine, but it has to be available for rent. Meaning if it's vacant for 2 months because you're doing construction, you can't count those 2 months of expenses.
Oh, really?
Yeah, because it's not like you could have had tenants in there and you just couldn't find them. You couldn't even bring them in because you were doing stuff. So if you physically cannot have tenants living in there, you can't count that month as an expense or as like a vacant month.
Oh, so you're not writing off your common charges or property taxes,
right, for the months that you're doing construction. So if you bought a house, let's say in January, and you spent 3 months doing renovations, then technically you can only count expenses starting in March because the house wasn't available anyway.
Interesting. Okay.
Yeah, so that's the only like caveat when you kind of can't deduct anything. But again, it also depends. For example, if you have a multifamily unit, you can be doing renovations upstairs and not downstairs, or you know,
right.
or if the owner, or if depending what the renovation is, if it's not anything too intrusive and, you know, tenants are fine living there while you're fixing this stuff, that's also an option.
Interesting. Okay. And then improvements. Talk to us about improvements.
So capital improvements have to be depreciated. So again, you're not going to be able to get the entire value. You're not going to be able to get the entire deduction of the cost of the renovation if it's capital improvement. Capital improvement is essentially, honestly, sometimes I have to ask myself also what we can consider capital and what we consider repairs. But my rule of thumb is anything that you cannot take with you if you move is considered capital improvement. So if you redo the floors, if you redo the kitchen cabinets, right? But even within the entire project of doing the renovations, you can still separate between what's a repair and what's capital improvement, right? So like labor costs we can take as repair right away, right? Like you don't need to depreciate labor, you know, the cost of labor. Certain materials, like if it's tiles or I don't know, certain planks or certain decor items, for example, right? But installation is capital improvement, right? New kitchen cabinets that you drill into the wall, that's capital improvement. If you're redoing the piping in the bathroom, right? Like that's capital improvement. But for example, the tiles, right? So like what I always do, like I just renovated my bathrooms at home, and I had my contractor very clearly list out what, you know, what was done and what the cost was, so I can separate it out. So what's capital improvement to my office and what's actually repairs.
So why would the tiling, for example, you can't write it off?
I don't know, like it's just my idea. Like not anything particular, but for example, like the tiles, it's materials, right? Technically, I guess it would be more capital improvement. But for example, if you had like a mirror, right, like the vanity mirror, that's furniture, right? So that you can do Section 179, you can deduct that right away. So for example, the vanity, you can deduct that right away, right? Because you can claim that as furniture. But the tiles probably would be a little bit.
So what's the difference between a write-off?
You're still writing all of this off.
Yeah.
But the only difference is whether you can deduct 100% of it today, like in the current tax year, or if you have to depreciate it over time. Because if you depreciate over time, you're only getting a small portion of it today. You know, you're still getting a small portion every year, but it's, you know, it's not making that big bang for you in this year.
Oh, that's interesting. I did not know that.
Yeah.
So if let's say your tenant moves out and you do some sprucing up to the apartment, you do your paint job, you have the super come in.
That's repairs. Paint, that's a repair. Fixing holes, patching up holes, that's a repair. Repolishing floors, that's a repair. If you need to change an appliance, that's furniture, you can deduct that right away.
And that all gets written off that tax year.
Yeah, that gets written off that tax year.
Interesting. Are there like strategic benefits to capital improvements that people would like want to do or not want to do a capital improvement at a specific time, or does it not matter?
Well, as far as like tax wise, like I said, in the immediate, yes, you'll still get a small benefit, but because you're depreciating it over time, the benefit is less. But the other side of it is that it increases your cost basis of the property. So for example, if you buy a house for $600,000 and then you spend $100,000 in renovations, you're doing capital improvement, not repairs. Now the cost basis of your home is $700,000.
That's interesting. So for my annual turnover of my tenants or for my repair costs, that is not going towards my basis.
Right. So general repairs that you do doesn't go towards your basis. But that's actually another common thing that I see accountants miss. When they originally create the asset of the home, right, for the rental, they never count the closing costs and they never count the capital improvements, which is a big thing.
Wild.
Yeah, which is a big thing.
Wait, that sounds like huge costs to miss.
They are huge costs to miss. People will just put the purchase price and they won't add in the capital improvements, the renovations, the attorney fees, the broker fees, all those title costs, all that stuff that you pay, that people pay tens of thousands of dollars for in the closing process.
Yeah.
They'll miss it. You don't even know how many times like I'll go back and amend returns and add that in, just because I want it on the record for either when they sell it or if they want to do 1031 exchange later, which we'll discuss later.
But
you want to increase, you have to, there's a difference, right? You always want to plan two separate ways. You want to plan for the short term, which is how can I get the most savings today, but you also want to plan for the future, like how can I set myself up for the time that I know I will eventually want to sell my house, or the time that I know I will eventually want to do something, right? Like
right.
you want to plan for those times also. So you want to make sure that you account for all those expenses to increase the cost base, because it closes the gap when you sell. And same thing for sales. Same thing for sales. You'd be surprised how many times accountants just put the sale price and that's it, and they won't even count the closing costs. They won't even count repairs. Like I have a client who owns several properties in Pennsylvania, and every time we open a new property or we sell a property, like I squeeze everything out. How many times did you go there to clean it up before you sell? How many times did you go there for the open houses? How many times did you go there to speak to an agent? Did we clean it? Did we set up a staging, open house supplies, right? Because open house supplies, don't forget, could be anything. It could be decorative items, right, to kind of set the stage. And I guess this is more for real estate agents, or if you're, I guess, by yourself, you're selling, but this is really more for real estate agents. So you can set the decor and all that stuff, but you can also food, balloons, drinks, snacks, all that stuff counts. Little, what do you call those shoe covers?
The shoe covers,
the booty, all that stuff. All of that stuff can be counted.
So interesting. So we referred to a couple of terms that we know, but I wonder if everyone in our audience does. Can we zoom back a little bit and help people understand like the concept of your basis and how that affects what you owe in taxes when you sell, and like what is a basis?
Right. So the cost basis is essentially just the cost of the purchase of your house, right? Like how much did it cost you to buy this house, right? It didn't just cost you the value of the home, right? Let's say you buy a house for $700,000. It cost you $700,000 for the actual house, right? But then it also costs you $2,000 for your attorney fees. It cost you $10,000 for your broker fees, some license fees, mortgage fees, right? All of those fees count. So all of that gets added to your cost basis. So now instead of your cost basis being $700,000, it's $785,000, right? So then later down the road, when you want to sell it, let's say you sell it for $1 million, right? You sold it for $1 million, but then you also paid again your closing costs, your selling costs, your $1 million tax, whatever, your right? That's what's called the millionaire tax.
Yeah, the mansion tax.
Mansion tax, right? So you have the mansion tax, you have all of these, the closing costs, the open house supplies, all that stuff. If you hired a cleaning crew to come and clean the house for the openings, you count all of those. So now you didn't really make $1 million, you made $900,000 because you spent $100K on all of these expenses, if not more. So now the profit is not between 700 and $1 million, right? It's between 785 and 900, which is you close the gap by 100 something thousand, 120,000.
And you're saving capital gains tax, correct?
Yeah, you're saving capital gains tax.
Very, very interesting.
But there's a way to go around it too. So when we talk about capital gains tax for, like if it's your primary residence and you're selling your primary home, you automatically get an exclusion for the first either $250,000 or $500,000 if you're married. So if you're single and you sell your house and the profit is under that $250K, you pay no tax at all. And if you're married, you have a $500K. But the caveat there is you have to live in the house for at least 2 out of the last 5 years.
Okay, so as long as it has to be a primary residence.
So as long as on your tax returns it shows that you were living there for 2 out of the 5 years, you're considered living there, and then you can get the exclusion. You're eligible for the exclusion.
Very, very good stuff. Right. So make that investment property one you wouldn't mind living in for a couple of
basically
years.
Right. But with investments it's a little bit different, right? Investments innately you don't get that automatic exclusion because it's in its nature was purchased for the intent of profit, right? So you don't automatically get any exclusions for selling it. However, there is something called a 1031 exchange, and that's basically when you flip one house and you buy another house in its place, you essentially defer the gains, right? So let's say, for example, you bought a house for $200,000 and you sell it for $500,000, right? And in its place, you buy another house that's worth $500,000 or more, or multiple houses that equal $500,000. You could buy 2 condos, for example, right? Once you sell that house, so for example, let's say the cost basis, let's say the sale of the profit was $300,000. That sale price, that sale profit, essentially decreases the cost basis of your new house. So if before we were talking about it increasing the cost basis to close the gap, in this case, you're actually decreasing it to widen the gap because you're not. Technically, 1031 exchange doesn't forgive you from paying tax. It just defers the tax to the next house.
So if you sold property for $500K and you bought something for $500K, you're saying that the $500K of the first property counts against the cost basis for the second?
Profit, like the profit between between the purchase and the sale.
Right.
So if let's say there's a $200,000 profit, that $200,000 decrease. Let's say you buy your next house also for $500,000. We're saying that purchase price was actually $300,000.
Got it.
So this way, when you sell it, there's still that $200,000 adjustment for the taxes that you didn't pay originally. However, there is a way around this.
There's a way around.
There's a way around.
The thing that gets
around. Yes.
I like the way you think, girl.
My mind just goes in circles, I swear. I think I'm just like hoping, I wonder if I can confuse an IRS auditor enough that they'll just don't want to work with me.
Right? Like, literally.
No, that probably
Definitely.
won't happen. But wishful thinking, but that won't happen. But essentially what happens is, let's say you have a rental property, you sell it, you do the 1031 exchange. And there are some nuances, obviously, as you know, you have to designate the new property at the time that you sell the old one. You have a certain amount of time to close on the next one. There are some cases where you can get a little bit more time, but essentially it has to be done simultaneously.
Yes.
Right? If you use that property as a rental for 2 years, 3 years, 5 years, right? And then eventually make it your primary residence. Now you're back to the new primary rule.
Oh.
So essentially, like, if you live in that house for 2 of the last 5 years, now you have your exclusion again.
Really?
Yeah.
Ah.
Now, still, the gap is still a little bit wider, right? So your exclusion
Right.
may not cover everything, but you still got at least some portion of it excluded.
Right. Huh. Very, very interesting.
Or inheritance, for example. You can keep the house, and then if you pass away and your kids inherit the house, you automatically get the step-up basis, so you don't even need the exclusion.
That's something that I wanted to make sure that we touched on
Yes.
in this. I feel like we've already covered so much, but when it comes to inheriting property, can you help our audience understand how they can inherit this property?
Yes.
And yeah.
So there's this misconception. People think that there needs to be a will, or that you have to be already included in the deed of the house. And actually putting your kids into the deed of the house is the worst thing you can do, because then they own the house already with you. So they don't become eligible for the step-up basis. So you actually never want to put your kids in the name of the deed, because they will automatically inherit the house anyway as next of kin, or if you have a will or a trust, it'll just automatically go to them. I actually recently learned that if you have it through a trust, it bypasses the entire court system, and you essentially automatically get or it goes through much quicker, right? So
Right.
the waiting period is much shorter, and you inherit the house, from your parents, and now you can elect. I'm not sure if this is done at the time that the property is that you like inherit it, right? Or if there has to be like a legal document within the trust. But essentially, you elect that to absorb the step-up basis. And what it says is that if your parents bought this house 15 years ago, 20 years ago, 100 years ago for $50,000, and now it's worth $1 million, instead of you inheriting it at the $50K value that they bought it at, you inherit it at the present day market value. So you don't even need an exclusion. You don't even need a 1031 exchange. So if you do decide you just want to sell this house, you basically have no profit, because you got it at market value, and you're selling it for market value.
Right.
Or even if you make a small profit, you're talking about pennies compared to the hundreds of thousands that it would have been.
That was so interesting. And you mentioned inheriting property.
Mm-hmm.
So is there a tip that you have for anyone inheriting property that doesn't intend to quickly sell it that year? Is there something that they should do when they inherit the property to make sure that they record the proper basis at the time of when they inherited
Yes,
it?
I recommend they contact you and get an
you.
appraisal. Yes, I recommend you contact a real estate agent, Christina particularly. Only Christina knows how to do this.
Right.
No, but you do an appraisal at that time, so that there's on record. The biggest thing for the IRS whenever dealing with step-up basis or sales or anything on your tax return is what you can prove. They don't make anybody kind of dig through records, jump through hoops to understand what you mean, or to, right? Like, these people, they just want simple, stupid. Give me what I need, have it outlined, dated, time-stamped, and we're good to go, right? So the best thing that you can do is pay the couple $100s, get the appraisal for that time period, for that day, and then you're saying, okay, I inherited the house on this day. We did an appraisal. This is this is what the house is worth. This is the step-up base. This is the value that I'm accepting as a step-up basis. So now, once you've already acknowledged, okay, my value of the purchase price of the house is $1 million and not $50,000, you can go ahead. I as a matter of fact, I always recommend to, if possible, not to sell the property, because if you have a home that your family's owned for 15 years, 20 years, first of all, you probably have very low mortgage on it, if any, right? Even if you do, it's probably a very favorable rate. Could be. Right? But more likely it's just that most of it is paid off already. So as you get closer to having a mortgage-free property, why wouldn't you want to keep it?
Right.
And keep it as an investment property?
Rent it out. Exactly.
Rent it out. I'm a huge supporter of renting it out.
Right. Yeah. I think when I talk to my clients, I think the biggest pain points are carrying the property, depending on if it has taxes and fees associated with it. I mean,
you have like the property taxes that you still have to pay and all that stuff, but
yeah,
but all those fees should be incorporated into the rent that you charge.
Right, exactly. I think that the only reason why some of my clients still decide to sell, even if they have the option to rent it out, location. Sometimes they're like, I don't want to deal with a property that's all the way over there.
Hire management.
Right.
Like, pay the 10% fee to a management company and have them do it.
Or your agent.
agent. Why?
Yeah.
The agents can be manager also.
We rent it out for you. I field all the tenants' questions.
Oh, do you? I didn't know
A lot of what I do for my landlords. I don't know if I would consider it property management, but I'm usually like the first line for questions and repairs. Like I'm not doing the repair myself, but I'll help them coordinate it.
Right.
Yeah. So you can
exactly. Like why not have extra cash flow? I feel like the biggest, like on the subject of pain points, the biggest concerns that I hear from my clients also, like the pushback is dealing with bad tenants.
Yeah.
Like that's the biggest fear, and that's valid, right? Like you never want to get stuck with a tenant that just won't pay you or will trash your house,
right?
Which is a risk, right?
Right.
But I feel like those are not
they're the rarity. They tend to be the rarity. I'm like knocking,
right?
Like yeah.
I feel like they tend to be the
when
rarity.
we rent out apartments for our clients, we do very thorough checks. Like everything that we are allowed to do legally by law, we will do. So we do background check, we do credit check, and that's usually where if there's a big red flag, you'll see it there.
Right.
So we do this, and then
do you find that there's a different demographic that's more risky? Like, for example, is it more riskier to having like younger college kids versus like a family move in, or do you feel like
can't say. So fair housing law. First of all, I don't have that answer, but
I guess it's more like
even if I did, fair housing law will not allow a real estate agent to pretty much give any information that has to do with demographics at all whatsoever.
Oh, really?
So, yeah, we're literally not legally allowed to. So a lot of my clients will ask simple questions like, "Oh, is the building mostly families or young single people?" I literally can't. Like I can't say anything.
Because like, well, how do you know you're moving into the right place? Like you want to be around.
I know there's very little. I know, and we feel it a lot too. And our clients are like, "That's ridiculous! Like paying you to help me find a place that
well, it's not like you don't know
works for me, right? And all that we're able to do is direct them to like websites where they can find the information they're looking for, or we can recommend that they like observe for themselves, like hang around the building, hang around the neighborhood.
I have a question for you though. So let's say you have someone who's looking for a unit, right? But you know the demographics of that building, right? So can you just say like, I can't really disclose that information, but I think you'll really like this building?
Well, I guess that the general understanding is that if I have a client, like I'm not going to stop my client from talking. Like if my client wants to tell me that they want something specific, I will hear it. So I know if they'll like it, but we really are not allowed to allude to any, like we can't.
I understand.
You could assume that the showings I set up for you are for
within
places
the parameters
that
of
I feel like you would buy, but I'm not legally allowed to limit the apartments that I show you to.
Oh, you're not even allowed to limit them. Oh.
I can have a client tell me like I want to be in a certain neighborhood, I want to be in a certain zip code, I want to be within a certain block. So sometimes if a client is like, I want to be in a, like we're kind of straying, but it's interesting, so whatever. If a client's like, a lot of clients will say to me, I want to be in a safe neighborhood. I am not legally allowed to decide
what's safe and what's
where
not.
to show them. That's considered steering. Yeah, I am not allowed to do it. So what I would do is I would ask them to give me a radius of what they want. Like, okay, are you interested? Like, what streets are you interested in? Okay, I'm willing to go from this street to this street because like people that know the area, they know the area.
Right.
So they want to be in this street to this street, and they're giving me explicit direction to limit their search to certain streets.
I understand.
So I am allowed to follow that direction.
Right, of course.
I can't tell someone you have to take an apartment that you don't want to be.
Of course.
But I am not allowed to make that call for them. And the other ironic thing is that you might think an area is super safe and you might think another area is super dangerous, let's say. And then a crime can happen in the safe place anywhere, too. Of course. You know, like, of course. So I always feel like I don't even have the authority to.
Right.
And a lot of people already know what they want. So they can explicitly direct. But, or I can arrange the day of showings and they can assess as they go if they like the vibe. And if they don't like the vibe in a certain spot, then we rule that building out, and they might tell me, like, don't take me there again.
Don't take me there.
Yeah. And we're like, okay. No problem. Neighborhoods are changing. They change very quickly, too. And half the time, like, you may take something in an area where you didn't expect yourself. Right. You didn't picture, and then it's like the greatest decision you made.
Honestly, that happened to me where I live now. It's not even that far from where I grew up, but I've just never been to that part of Brooklyn.
Wait, you live very close to where I grew up.
Yes, I think so.
Yeah, South Brooklyn.
Yes.
Yeah.
Yes.
So you wouldn't have pictured yourself there?
Not really. No.
Not because it's not good.
No,
I
not
always
because
thought
it's
it was
not
very
good. It's great.
beautiful.
No, it's beautiful. I love it. It's like a little bit further.
It's further. It feels
it's further.
like.
So it's even, just when I was younger, I never, found myself in that area.
Right.
But I'm actually really happy. I love the house and I love the neighborhood.
It's beautiful.
Anyway, we're totally straying.
We've strayed.
I'm sorry, we're straying.
Sorry, guys.
Welcome to our personal life, where we live and what we like. Anyway, but I did want to share with you actually a very interesting tidbit, and this really relates to any business owner or even someone who doesn't have a rental unit but wants to sublease their unit for a short period of time. So there's something called an Augustus rule, right? And the Augustus rule basically says that you can rent out your primary residence to yourself for up to 14 days or to anyone else for up to 14 days, and you don't have to report this as income.
Really?
Yes. So you have situations like this. For example, let's say I leave on vacation for 3 weeks and someone is willing to rent out my house for a week that I'm gone, right? And they'll pay me whatever I would charge normally for, let's say, a night, a night stay I charge them for a week. I don't have to report that income. And simultaneously, let's say, for example, right? You have your business, you're a real estate agent. Let's say you want to rent out your home to your business for use. Now, let's say you're saying like, I'm going to host a retreat in my house for 5 days.
What about this right here?
Literally right here. Yes.
We are using my home as
but the caveat we're talking about for the whole house, not just using the space. I'm talking about you're leaving. You're not staying here for 5 days, right? Like so. Let's say you go and you stay with your parents for 5 days, and you say, you know what, like I really need a space. I want to host a retreat for other real estate agents, right? And I'm going to come up with a package where we'll imagine like a retreat. Like if you go travel anywhere else, right? They have a schedule for the whole day, lessons that they do, content shooting things, whatever, group learning, right? Like some downtime. So imagine everything you would spend on a retreat. You say, you know what, instead of me paying thousands of dollars to book a retreat somewhere in Costa Rica, I'm going to use my house in the middle of Manhattan, right? So I'm going to sublease it to myself, to my company who's hosting this retreat. So now let's say I'm going to use my house for a week and my rent is now a quarter. I'm going to charge myself a quarter of my monthly rent, right? I'm going to pay that. I'm going to have the company. So for example, Christina's company will pay Christina personally, right? To rent the space. Now you have a deduction to the company for the rent and you don't have to report that, and your company can write it off.
And can it also write off the other expenses associated with this retreat?
Yeah, of course.
That's really cool.
Right. So the retreat, of course, like all those expenses associated with it, you bring in professional social media people, right? Massages, whatever, right? Let's say you have a group of 10 real estate agents and you're saying like, you know what, like you all live in the city, so we don't need to book hotels, but we do need to meet somewhere every day to go through these lessons and to practice content creation and to shoot podcasts together, right? So let's say we can have a schedule of 5 days where we're recording stuff and learning from each other and so forth, right? You organize everything, you hire the people who will come in and do it, you pay for all those things, it's all deductible. But now on top of that, your company can pay you rent for using your space for the 5 days, and you don't have to report it as income, but your company can still deduct it as an expense. And that's called the Augustus rule. Fun fact.
Wow.
Fun fact. This stems from obviously golf. This happened in Georgia. There was some golfing competition. I think it happened in August, Georgia. I'm pretty sure. There was some golfing competition, and I think there was like an issue of where to stay or something. So Georgia basically made a rule, or somehow this rule came to be, that you can sublease your house for up to 14 days during this golfing tournament and not have to pay.
That is so interesting.
And not have to report that. Obviously, everything revolves around men and golf.
Does it have right? Of course.
Of course.
Can you only do this once a year? Does it have to be like all the days used at once, or
it doesn't have to? It's just 14 days in total for the year. So you can do this every year, but you have to sublease for up to no more than 14 days.
And if I do this once a month for a day,
you could do that.
I can do it.
Yeah, you can do that.
That's so.
But like, what are you renting out for like a day? Like, how much rent are you paying for a day? $150?
Right.
That's not
right.
That's too much work. You want the juice to be worth the squeeze.
Right.
So you want to, especially when you consider your rent for the month, right? You want to be able to deduct at least, if not, directly, let's say half of it. Right. So you can have the 2 weeks besides taking the home office expense, which you still will take anyway. So now you'll get a portion of your whole rent for the year anyway, but then you can deduct even more so for rent. I have a client who is an event decorator. No, I'm sorry, not interior decorator. And he has partners in the UK. And when they come to the US to meet with him to work on projects, he gives them his house so they don't have to pay for a hotel to stay, and then he goes somewhere else, and in this way he's able to write off a week or 2 weeks of however long they're here for the rent. So he basically charges his company rent.
Very interesting.
Yeah.
Very, very interesting.
See, this is the best thing, right? The best thing for me is coming up with deductions for things you didn't even pay for.
Huh.
right? Because that's really where
Right.
we're talking about tax strategizing and true optimization, right? Because yeah, your home rent everybody knows, your office rent everybody knows, your telephone everybody knows. What about everything in between? What else can we do to utilize? Like, well, what can we utilize to save us tax dollars? Right? And that's one way we can do it. Same thing with, there's even a per diem rate. So for example, if you're a real estate agent and let's say you're licensed in New York and New Jersey, right? And let's say you go to New Jersey and you're going to be spending 3 full days of house hunting or showing clients around, for example, and you don't want to commute back and forth because it's just, killing time. So let's say you say, okay, you know what? I'm going to stay at my family's house in New Jersey while I'm doing the work, even though you live in New York. There's something called a per diem where the IRS basically says, even though you didn't spend anything for lodging, there was an acknowledgement of cost incurred to host you. So you can deduct so the IRS has a price rate for every city in the US per night per month, depending if it's high season, low season, or whatever.
Wow.
Yeah, so you can literally go on IRS's website and say, okay, I'm staying in Morristown, New Jersey in March of 24. How much is the hourly rate? And you can go ahead and deduct that.
Very interesting.
But that's only for corporations, not for LLCs or freelancers.
So interesting. So do you see a lot of people benefiting tax-wise from purchasing multiple investment properties and maybe like refinancing their first one to buy a second one and then using leverage to purchase more investments and obviously earn more rental income? Is there a tax side to it, or is it just like what I just
said? It's not really a tax side, honest. So when you're talking about people, when your income is over a certain limit, I don't remember exactly, maybe it's like 100,000 or something like that, like right around that mark. If your income is over that, then you won't be able to recognize the loss from rental properties anyway.
Really?
Yeah. So for example, like if your family household is 250,000 and you have a rental property and you lost, let's say $5,000 on it, that 5,000 will just carry over and it'll keep accumulating and will offset future gains or the sale price for when you sell the house.
So,
but it won't decrease like your taxable income by $5,000 in that tax year.
Oh, so when you depreciate my property and you net out negative on it, I'm not saving that year? Wait, that's actually, I had no idea. Yeah. I'm like, I'm writing off my thing.
No,
like, I have no idea what's going on.
But again, it's not lost, right? It's not lost. And this is the biggest thing. Everything that you have to look at as either, is this helping me in the short term or is this helping me in the long term? Both are great, right? Yes, obviously we want money in the immediate, but we also would like money 5 years from now, 10 years from now. So all of these losses are accumulating for you so that when you do sell the house, sell the investment or whatever, if you do decide to sell it, you're going to offset your accounts against the future gains.
So it would be sale price minus basis,
minus all of those losses. Yeah.
Okay. That's
but also keep in mind that when you talk about investment properties, and this is kind of works against you, all of the depreciation that you wrote off over the years gets added back. So let's say if you had the house for 5 years and let's say you wrote off $5,000 every year, at the end when you sell it in 5 years, $25K gets added back to the value of the home. You know what I mean?
I did never really understand depreciation because you're decreasing the value of the property by like 1/27th, for example, for residential over time.
Yeah.
But properties usually increase in value.
They do increase in value, right? And this is what I have this argument so many times, especially on social media. Where everyone's like, everyone's a professional. They're like, no, how properties don't depreciate. They all go up in value. It's like, yes, they do, right? But all the items inside have wear and tear, right? Your kitchen that you purchased 15 years ago for $10,000 is not worth $10,000 today, right?
Right.
So it depreciates. That's what it is. So the items inside the house, the wear and tear, the floors get old, the pipes get old, the pipes need to be redone, the electricity needs to be rerun. All of that is wear and tear. Like those things don't hold value. The home, the structure, the foundation, sure. Right. But the house still depreciates.
Would you say that there is a greater tax advantage to owning the home that you live in, or in general, do you see more tax advantages on a primary residence or on investment properties?
Honestly, again, it's very situational because it depends on your income and if you're able to recognize the tax benefits, right? So for example, on the one hand, yes, if you own your primary home and that's where you live, you can write off mortgage interest and real estate taxes, and that helps you cross over the standard deduction, like if you're a W-2 employee. So that does give you a little bit more money back in your refund, and it gives you more advantage right there in the year, right? And you also get the exclusion when you sell it. So on a very simple basis, yeah, that seems to check all the boxes. You get the immediate and you get the future gains, right? But you're not building wealth that way per se, right? It's still a very short-sighted perspective on financial growth, right? On wealth building, on generational wealth building. And this is something that I think people really don't ever think about. And I'm not even talking about people who are really high earners. We talk about the average person. Generational wealth is not only for the rich. Anybody can start building it at any time, right?
I love that you said that, yeah.
Because it's true, right? Everyone thinks that this is not me. Like, I don't have millions of dollars. Like, no, you don't have $1 million today, but if you invest into something simple like an S&P 500 from the time you were 15 and you keep money in there till you're 65, 75, 85, you'll have over $1 million in there, right? And you can pass that on to your kids and so forth. And that's a very trivial way of building generational wealth, right? Because you're only relying on one medium, right? Which is your retirement account. But for example, like I'll give you even an example, like our house, right? Like when we bought it like right during COVID, we knew that was a great market for a buyer, right? We knew we were getting a very advantageous rate. We knew that we were, especially in the area that we were looking at, prices of homes weren't really jumping, so there was no competition, right? So I knew that what we were getting was a steal, essentially. So right from the beginning, we knew this was going to be an investment property where we bought a house that was below our means, that we know we could easily afford now and still save a lot, so that in the next 5 years, 10 years, we would have saved enough to buy our next home and not needed to sell this house. So in a very simple, right? Like it's basically saying like, I know I could afford a more expensive house now and I'll have the walk-in closet that I want and I'll have the, freestanding tub that I want, but then I'm not building long-term wealth, right? I'm only actually giving myself more debt.
Right. But with real estate, you feel that is a vehicle where you really can build wealth on a grand scale.
Property will always go up, right? Even if markets fluctuate like the stock market does, right? In the long term, it always goes up. So even if there's a recession and even if there's a time where it's a seller's market and not a buyer's market or vice versa, in the long term, when we're talking about 15, 20 years, the value of your home will jump so much. And even think about the rent. How much? I remember when I was 20 years old, a studio apartment for rent was, you can get a good one for like $700. How much is a studio apartment for rent now?
$3,500. Ridiculous.
And that's like 15 years ago.
Right.
So imagine
in the city at least. Yeah.
Well, okay, so fine, in the city. Fine. Well, if you talk about 15 years ago, how much was it in the city? $1,200 then? $1,300?
Probably closer to 2,000. Yeah. 15
years ago, you think it was 2,000 in the city?
It was around.
Fine, so let's even say.
But that's still a big jump.
No, it's still a big jump.
I feel like the city is very overpriced. Not overpriced. The city's expensive.
It's
expensive. The growth in the city is at a slightly slower rate than where you see in like
Brooklyn or somewhere
outer. Yes. Brooklyn is leaping and like galloping.
Oh my God.
Leaps and bounds.
Rent is so expensive in Brooklyn. Like I said, like I remember in Brooklyn when I was getting into high school, rent for a studio was like $700-800. Now studio rent is like $2,200, $2,300, $2,400.
Right. Yeah, it's insane.
It's insane. So the rent will always go up. So if you're able to hold on to that house and pay off that mortgage, and even if you just make one extra payment a year on that mortgage, you'll kill off that mortgage so much faster and you'll save on the interest payments.
Right.
And now you have this investment property that you don't need to sell, that you can just go buy your next house, the bigger house and get the dream house that you want, right? But it's about, I think it really comes down to self-discipline and self-awareness, where again, it's that balance between what I want now and what my future self will want.
Yeah.
And
so it's so interesting that you say that, and I agree. I do agree. I think that people see purchasing a property as a big deal, of course,
is a big deal,
right? And on top of it, it's people's default mentality towards it often, not all the time, but often is, the American dream. The primary residence, and they feel that a lot of people also feel that if they're renting their primary residence, it's a bad financial decision. I think that there are many different ways that you can still invest in real estate without it being a primary residence, and for it to be a very good decision financially. And I actually have this debate with people all the time. Not a debate, but even clients. Because oftentimes my client will express to me, they'll say, this is exactly how the conversation will go, and I find it so interesting. They'll want to buy. Like, they're ready to buy something. They've got enough money where we could do down payment and closing costs. But after discussing with them how much money they have, what the budget is, and what they want, they do not have the budget for their ideal primary residence.
Of course not.
So the primary residence is still out of reach. So they might be able to buy a starter home, but starter home in the city is still quite expensive, and getting to that next step when you're paying on your starter home is not easy. So my recommendation often is, and it hits them out of so left field, but I've had many clients go with it and they're so happy. I say to them, I run comps with them, and I'm like, what would it cost to rent this ideal home versus owning it? And usually it is much more affordable to rent that property than it would be to carry it with owning it in the
100%.
today, right?
Yes.
Like even when you're buying a rental property, my clients are always like, I want the rent, I want to be in the green. I want my rent to cover
We
what
all do.
I'm paying. And if you're getting a mortgage like many people are, that's not happening today. It's going to happen later, and that's the benefit long term of an investment property. But right now, it's cheaper to rent the property than it is to carry it.
Yeah, 100%.
Especially 100% if you're getting a mortgage.
Yes, 100%, especially with these rates right now, 100%.
Right. So I propose to them, let's rent your dream property. Let's pay much less than what it would cost to acquire it. You need a smaller, all you need right now is the cash for the security and your rent, and you can move, and you got what you need now today.
Yeah.
And then let's take whatever you have and buy something within budget for you to rent out. And you're getting to live in your dream home for a much more expensive price today. Mm-hmm. And now you are buying a property, and this is where they get confused. So they're like, okay, but how am I making money on that? Because I'm paying a mortgage on the second property. And they're like, so even if I'm collecting income, I'm not making any money because I'm paying a mortgage. And if I'm collecting rent, and if I'm lucky enough for it to be a wash, I am netting out at zero. So where's the benefit to this? It doesn't make any sense to me. And plus on top of it, I'm paying rent.
Yeah.
So what they end up realizing is that you're netting out at zero in terms of how much money is in your bank account or wallet maybe today.
Yeah.
But
you're building into the equity.
But you just essentially hired someone to pay off your equity. Mm-hmm. So now you have an asset building in value.
Yep.
That someone else is
so
paying
smart.
for. Someone else is paying for it. And you got to have the quality of life improvement that you needed by renting for a cheaper price today.
Yes.
And you will eventually have the ability, instead of paying out of your means for a primary today and maybe never getting to the next larger property because you're paying all your monthlies out in your primary, maybe now you can save a little bit.
100%.
Refi the investment property, take out some cash for your next down payment, and buy another rental or buy your primary. Buy the primary if you really want to own your primary. Buy it when you have the ability to. But sometimes you maybe you just got married and you're having a baby. You need that bigger apartment now.
Yeah.
But you wish it could be something better than what you could afford today. I think that's a good way to get it.
I agree with you 100%. First of all, I think that's great advice. That's really solid. I've never heard a real estate agent tell their clients that, so this is the first time I'm hearing it.
Interesting.
Yeah, no, that's amazing, and I agree with you 100%. And this really just goes back to that. It's that patience, right? Nobody has patience. Everybody wants to, and to be honest, we saw that right during COVID. How many people fled the city to Jersey?
Oh my God, it happened so fast.
It happened overnight. Everybody fled.
I'm like, how did you decide that you're like all of a sudden you're a suburb person,
right? But
like, forget how did that happen?
But did you see what happened in that market in Jersey, right?
Yeah.
Prices skyrocketed, right? People were overpaying by $100,000. They were in what do you call that? Like bidding wars.
Bidding wars.
They were in bidding wars for over $100,000. People offering $100,000 over asking without even seeing the house, right? They raised the value of all of these houses, right? Half these people didn't even put down 20%, right? They put down significantly less, and they think that they're saving somehow, but all they did is now pay significantly more in their interest payments, right? So now that house is costing them an extra $300,000. People really don't realize that by saving that $50,000 in your as part of your down payment and keeping in your pocket, you're hurting yourself 5 times worse, because on that $50K that you save, first of all, it's losing money while it's just sitting in the bank, right? With inflation, it's like in a year you no longer have 50, you have like 47,000 in there now, right? Whatever it is, 46. You're paying significantly more in interest. So over the 30-year loan, your $600,000 loan will now be close to $1 million.
Yep.
Right? For what?
Yep.
For what? So like, what did you save? Like, and you overpaid the house by $100,000 to get that low interest rate, but now and you put down less down, so your monthly payment is still as high as it would have been at a higher interest rate.
Yeah.
So there was literally no savings.
It's and you see a lot of clients that.
So I can't tell you how many. I
couldn't believe how fast people just uprooted. And I have a lot of clients that I really respect that, it didn't affect how I see them, but I was very surprised. I'm like, whoa, how did you that's like such a wild decision to make. And they gave up the Manhattan apartments, and they were like fully country.
You see, like they should have kept that Manhattan apartment and subleased it, because now,
now you can't get it.
You can't get it like at that rate. All the rent prices went back up, right? Like there was
the episode that I recorded directly before this one. It talked all about that.
Oh, really?
Yeah, exactly why you cannot get a rental today.
You know what I mean? Like if they were smart, they would have kept their apartment, even if you wanted to go listen, right, keep your apartment at the, or
and if you have the luxury available to you to up and go, you'll
find a tenant to
you're not spending your last dollar. Like, you have some flexibility probably, so maybe you could have held it in. You could have found sublet it. You could have sublet it. You could have found a tenant who's willing to take it at a lower rate. I need it. Like, a lot of these people that I know that did that ended up back.
I'm telling you, it's
hard to get back in.
I think that we're going to see, and I think this is not at all related, I guess, like to real estate, but I mean, it's related to real estate, but not tax-wise. Well, although it is tax-wise. I think you're going to start seeing a huge amount of foreclosures coming up in Jersey. Did you know that New Jersey is already the #1 state of foreclosures?
Really?
Yeah.
I did not.
I think it's like right in front of Arizona, or like it's right around. It's like tied to Arizona. But I think last time I checked it, New Jersey had the highest rate of foreclosures.
So interesting. And I also heard that in Florida, which is another area that happened to a very big degree.
Yes.
Insurance payments for flooding are like through the roof. Like, they just went up significantly, and people are having a big affordability issue.
Yeah.
And
but even rent there went up.
Yeah.
I remember my brother moved there right before, or he was moving there. Like, I think it was like right before, and he was like renewing his lease. And they were basically wanting to charge him like $1,000 more. And they said, like, we don't care if you move out. Like, there are literally 10 people ready to jump and pay us more.
Wild. And it's funny because I did like an episode, the one that posted just before this one, it had a lot of market information in it. And it was about what would happen when the rates drop, but there was a lot more in that episode. And I also mentioned that I anticipate foreclosures. And the way I was seeing it was more related to the fact that there's a lot of pandemic-related assistance that is expiring soon. It's starting to expire.
Like what?
So there are a lot of business-related and commercial-related pandemic relief funding that is being given to businesses and commercial owners that is set to expire. That is expiring. Some of the programs are getting renewed. Some of them aren't. But I think that there's going to be foreclosures, I think, in commercial and businesses that it's like being artificially propped up right now to a certain extent. And that's one of the other reasons why I feel like the housing, like, we have to see what goes on with the overall economy, because that could be an interesting like development that wouldn't be great. But
I'm telling
with that said, these people own regular homes too. Like, they own their primary residences too. What happens when that happens? Like, when the money that they've been depending on is drying up, and they have now to figure out the business and to figure out, it's not good overall. So I agree with you, though. A lot of this, like, these impulsive decisions.
It's very impulsive. I think that I think people just saw like all of these massive moving to Jersey, and I get it, right? During COVID, when you couldn't be outside, everybody wanted space. Now everybody woke up and realized that a backyard is nice. And it's like, yes, cool, but you understand COVID is only going to be around for so long. Okay, it was around for a year, 2 years.
That was the most interesting thing. I couldn't believe it.
Very short-sighted.
Right. I saw the pandemic as something we were working towards getting through.
Right.
But people like really changed their entire
life. People treated it like this was the new world order.
It's so interesting.
And that's what I mean. It's a very like humanistic flaw where people start to panic and they think this is the new norm, and they see other people doing it, so they think that this must be right, and then everyone's rushing and everyone's doing this. But it's I don't know, like there's no, I mean, and I was listening to like I heard like the worst advice. Like I knew someone who's like a mortgage broker and was telling people like, you don't even need to put down 20%. Like, money's not worth anything right now. Like, you should just keep it. I'm like, why are you telling people that? Like, if money's not worth anything, why are you telling them to keep it?
Right.
Like, if money's not worth it, why should I keep it? Why wouldn't I invested into something?
It's very, very interesting. And it's interesting when I notice how quickly people do things. Like, people tend to be impulsive, but also as a real estate agent, I'm very surprised at how quickly people's personal situation changes. And I work with clients, we'll buy something one year, and the following year we're doing something new. And I never thought that I would see that. But when I first got in the industry, they're like, repeat business is everything. And I'm like, okay, did a bunch of deals in year one. I'm not going to see these people for probably 10 years.
Yeah.
But it was the following year, and it's so interesting. But there
must be like a particular situation, right? I can't imagine that that's like a common, like most people don't.
I don't know. I think it's also maybe it might be a Manhattan thing. Like Manhattan, people are bouncing around a lot.
Maybe.
And their needs are changing, and their situations might be changing. But I find that I'm always very surprised. I'm like, wow, I didn't expect to hear from you already.
Oh,
I'm happy about it.
Yeah, of course. It's great for you.
Yeah, it's very interesting.
But that's different, right? Like having something change in your life. Okay, that happens, right? I also have clients who moved and bought homes, and then all of a sudden got a better job offer in another state, and a year later they're moving, right? Like,
but that's the thing. Like, you're selling and buying again. Like, it's
also,
it's
by the way, on that topic, because going back to the exclusion, right?
Should we link this back to taxes somehow?
Yes. So this is linking back to taxes. taxes. So if you live in your primary home, right, to get that, to be eligible for that 250K or 500K exclusion, you have to live in the house for at least 2 of the last 5 years, unless you qualify for some of the exemptions. The exemptions could be medically related, death related, or even work related. So if you get a job, if I bought a house in Long Island and moved to Long Island today, and then in 6 months I get a better offer for a job in Florida and I decide to move to Florida, I'm excused from I still get the exclusion for the 250K.
Really?
Yeah.
And you could be subletting that property in the meantime?
Well, no, if I'm living there, that's different. I'm talking about if I want to sell it.
So if you're living in a place and then for work you need to move elsewhere, and
so you have to live in a place as your primary for at least 2 of the last 5 years. So basically at least 2. So if you bought a house, you have to live there for at least 2 years before you can sell it and be eligible for the exclusion.
Oh, if you live in a house for less than a year, you don't get it, period.
You don't get it, period.
If it was your primary residence.
Correct. You don't get it, period. You don't get the exclusion at all. You have to meet that 2-year requirement.
Oh,
so I would have clients literally who are like, let's say, just short of 2 years, and they will push the closing to the day after the 2-year mark just to be able to get the exclusion. But unless you have one of these exemptions, like a new job, where you have to move somewhere further, I think it's not even that far. I think it's like 50 miles or like 100 miles, like something not crazy. So if your job is 100 miles further from your house and you move to if you move to a home that is 50 miles closer to your new job than your old job, then you get the exclusion for your primary residence.
Very interesting. That is very interesting. That's so
I had that happen to a client. They bought a house in Long Island. They lived there for like a year, just barely a year, and she got a better offer for a job in Florida, and she moved to Florida, and we were able to get her the exclusion so she didn't have to pay any tax on the sale of her home.
So I typically tell my clients to plan to be in a real estate investment for at least 7 to 10 years before you expect to sell it for any profit. I don't like the idea of like quick flipping unless you're doing some like significant renovation and you really have the resources to do it.
100%.
Do you feel tax wise that people see better like benefits from holding property longer versus selling it quickly, or does it work out the same?
Honestly, I think it really, again, depends per house, like how much you bought it for, how much you can sell it for, right? Because keep in mind, if we're talking about flipping, we're not talking about primary residence. We're talking about investment properties, right? We're talking about people who do this for a living, who buy homes and update them and sell them, right? So in those cases, you don't really have anything. You're not eligible for any kind of exclusions. You just have to try to squeeze out all the expenses you can to close the gap. So that's where we start talking about, well, how many times did you travel there? Maybe you paid a cleaning crew. Maybe you paid something for open house supplies. Maybe you did repairs there, like pre-sale repairs. As a matter of fact, it's interesting. I didn't realize this, but until 2 years ago, when I caught this by mistake somehow, I don't know how I didn't know this, but I was filling out. So when you have an investment property or a rental property, it gets reported on Schedule E, and you can deduct right on the front of the page, I made this much for my rent, these are all my expenses, depreciation, whatever, here's my net, right? And that gives you one end result. And then when you go to sell that property, you have to sell off the asset. So when you go to the asset worksheet that shows, when you bought it, how much you bought it for, and then you mark it sold, the system will automatically add back the depreciation, for example, and then you have to go in and deduct, my closing costs, my house supplies, whatever, right? You actually save more money by having the expenses on the front side of the sheet on the rental versus having them as selling expenses.
Really?
Yeah, I don't know. I don't know why.
Is it like it's a different way that it gets taxed?
I guess, or just a different way that maybe it just adds to the loss, and that loss is what gives it a different. I'm not 100% sure, but I just know it's a thing. It's like, was that Bill Maher? Like, I don't know for sure, but I know it's true.
I know it's true.
I know it's true. Like, I don't know how it works, but I know it's true.
That's so interesting.
Yeah.
Huh. So there's definitely benefits to like being a landlord.
There's definitely, I mean, of course there's landlords to being a landlord, the benefits to being a landlord, right? And again, it goes back to short-term benefits, long-term benefits, right? The primary goal is the long-term benefit, right? The longer you can hold on to an asset, even for investments, right? When you talk about regular stocks, the longer you can hold something, the better your chances are for return on investment. So if you're talking about having a rental and you can afford to keep it, or if you inherit your parents' home and you can afford to rent it out and not need, basically don't get greedy. Don't say, oh, I got my parents' $2 million house, I'm going to sell it and now I have $2 million in cash. Yeah, you can do that, but more likely than not, that cash is going to be burned like this. Right? Because the majority of people, and this is not an insult to anyone, but this is just statistically speaking. As a matter of fact, I read a recent study that said generational wealth is spent by the second or third generation.
Wow.
So meaning like if your parents are like really good at investing, save money, and they save enough for you, by the time your grandkids get it, they'll burn it.
That actually, I could totally see that being true.
Yeah, and it's unfortunate, and it's unfortunate because I think it comes down to discipline. I think it comes down to lack of financial education, right? It's the parents not advising the kids kind of like what to do when this happens, or having a good financial team to really advise you,
right?
But predominantly I think it's discipline. People just see dollar signs,
right?
And then they start seeing
it's nice to be able to get the things that you see that you like.
Of course it is. Who doesn't like nice things?
And it's actually really remarkable how not far a couple of $1 million goes.
No, it's not.
Like, it's surprising.
Yeah, that's true. It is surprising. People will not get what they think they're going to get for that money, or even
Right.
and that's considering if they even take that money and reinvest into property. How many times do those people just splurge it
On
right?
splurging
But
things,
on splurging
yeah.
things, on all of a sudden they need a BMW, and all of a sudden, and these things are great. I'm not saying obviously everybody loves a BMW, everybody loves a European vacation, all these things, but is that really where your main focus should be? And this is a personal choice, right? I'm not judging if that's what you want, but when we're talking about building wealth for yourself and generational wealth, that's not what you should be doing.
Right.
You know?
If you have an LLC that you have your property in, or let's say like your property, you own an investment property and it's like a business or something like this, are there other things that you could tie to the fact that that's like an income generating business that you can also write off? Like,
Not really.
no,
So there,
like you can't write off like a car or something like that.
no, so you can. That goes towards like traveling to and from to see the rental. So
Okay, so just to and from.
right. So there is a thing called an active real estate investor, right? And this is for people who, I forgot the details honestly because it's very strict, right? You have to be spending something like 500 hours a year, or like I don't even remember 1,000 hours. I don't even remember more maybe. It's some outrageous number, but you have to basically be spending full time working on properties. That
Managing.
That means you're going around buying properties. You're stopping by them every day. You're fixing stuff. You're going to look at new properties. Meaning this is your entire job. You don't have
Right.
any other daytime job. You don't have any other side business, and they're like you, and you get a big credit for that actually. But the IRS is very strict about it.
Right.
So you need to meet these very strict guidelines in order to be able to do it.
And that becomes like a business, like how you're writing
Right.
off your office supplies.
Right,
and-
right. But see, again, all those things
Interesting.
we can do anyway. So, for example, like I mentioned, I have a client who has multiple properties in Pennsylvania, and on each Schedule E, so Schedule E is where you report each individual property. On each Schedule E, I prorate a home office expense because this is all this guy does, right? Like he doesn't have a daytime job. Like he has these like 20 properties that he goes around and manages. He's always looking. He's always buying and new and flipping. Sometimes he's buying and renting. He's adding. He's selling. Right. This is his life. And so for him, for example, we'll prorate. We'll on one sheet compute whatever the home office deduction, all of the cell phone usage, the home internet usage, computer equipment purchase, whatever he needs, like a regular operating business expenses.
Right.
And then I'll just divide it amongst all 20 properties. Like technically I could put it on one, but I'll just like for even, for aesthetically wise,
Right.
for aesthetic purposes, I'll just divide it amongst all the properties. So each property gets a small deduction for home office expense, traveling expense, cell phone expense,
costs and
management,
things like
all
this.
that. Yeah.
Very interesting. Why did I think it was Schedule C?
Schedule C is when you're self-employed. That's not passive income. That's actual like real income. So like if you're a real estate agent before you incorporated, you were on Schedule C.
Oh.
If you're like a freelancer, if you're like basically if you're a single member LLC or if you're a freelancer, that's what you report Schedule C. Schedule E is just for passive income.
Gotcha. Okay.
Deductions for real estate agents, right? So
Yes.
again, this is and I say this across the board for everybody, right? I don't care if all 10 of you are real estate agents, right? All 10 of you run your business differently. Everyone sees their business differently. Everyone has aspirations for their business, has their different aspirations, different image, right? Different things that they think they can work. For example, you believe that podcasting is going to get you clients. Someone else will say, no one's listening to podcasts. I'm not spending money on that, right? So that's a unique deduction to your business. That's not a generic real estate deduction.
Right, not at all.
Right.
Yeah.
So we can talk about the generic, which everyone knows. Okay, it's your car, it's your home office, your home office, your cell phone, your home internet, your revenue fees, your key lock box, right? Like all of these things. Technically, also, if you're involved in staging, right? Like I have some real estate agents that really get involved. Like they get dirty, they clean the house. They'll get into while people are staging, they'll reorganize stuff. They get dirty, they get dusty from doing all the staging, hauling things in and out of trucks. So we can do dry cleaning expenses for you. If you buy anything with your logo on it, that can be deductible. For example, like clothing or t-shirts or some sort of like merch, that can be deductible. New things that I'm seeing particularly are social media related, right? Because that's where everyone is kind of going. Everyone knows that there's no one's really advertising anymore on like billboards or commercials, right? Because no one's watching TV. Everyone's watching commercial free TV.
Right.
Netflix,
So,
Netflix, right? Like people will pay to bypass the commercials. So that's not where you want to be spending money on advertisement. So for example, even like look at yourself, right? Like you have this is a deduction, right? All of the decor that you bought for this unit here is a deduction. The clothing that you're wearing is a deduction. If you had your hair done this morning, that's a deduction, right? Because
you think I got it done?
Well, you look gorgeous.
Aw,
like the makeup that you're wearing today.
Right.
That's a deduction for you, right?
You see my Sephora bills.
Yes, I do.
Or it's all on there, girl.
but the point is like all of this stuff is deductible, right? Because you're using this as advertising expenses. Think of it as like a photo shoot, right? Imagine any other company that would go and shoot an ad, right? The wardrobe is deductible, the hair is deductible, the glam squad is deductible, all that stuff is deductible. Staging supplies, a lot of times I'll speak to real estate agents where they say their clients don't want to pay for staging, right? The house is empty or whatever it is, and they just want to leave it that way. And the real estate agent really is like, you know what, I hear you, you don't want to spend the money on it, but I want to make the sale. So I will go out of pocket and I will rent certain items for the house to make it look nice because I really want to close the deal fast, right? And that's on you. So if you buy plants, if you buy picture frames, any kind of decor items, a rug, or even if you rent it, because I know there are companies that you can like rent staging items from. So that could be an out-of-pocket expense for you that you can deduct. So even though it's not yours, it's for, you know, unreimbursed, that could be a deduction. So we can talk about like, and the same thing going back to open house supplies. If you feel like I heard people, like I have real estate agents who tell me they're like, every showing is a cocktail party. Like this is their thing. Everybody knows that if you work with this agent, it's a cocktail party. It's fun. Everywhere you go, there's a cocktail. Yeah. So they will literally set up like a mini bar, like a really nice like mini bar station with like they'll hire a bartender to be there. Yeah. Right. And they'll make it a whole shindig. Right. So that's deductible.
You can write off alcohol too?
Absolutely. Not only can you write off alcohol if you're using it as part of your open house supplies, you can write off alcohol as gifts to clients. Yes. So, yes. So if you're gifting your client or you're a broker a bottle of wine, thank you for the referral, that's a deduction. Gifts can also be in the form of flowers, bakeries, like cakes. You kind of have to, I know that some more higher end real estate agents, like who deal with more wealthier clientele, they do nicer gifting, right? They'll go to Tiffany's, they'll go to Hermes, they'll go somewhere else.
That's where we're getting our closing gifts for our clients. Mostly, yeah.
Right.
We have
So it's that honestly is a very tricky area. People don't like to hear this, right? Because even though this truly is a gift, the IRS does deem certain things excessive and unnecessary. So you're kind of taking the chance of when you write it off, whether and how the IRS will perceive it, right? And it really all depends. By the way, all audits really just depend on the auditor that you get, right? You have to know off the top of your head, once you get audited, you're giving something up. You're not walking out fully handed, right? You have to give something up. So normally I would try to point the auditor in the direction that I want them to take, which is usually less of a loss than what I'm trying to have them not see. You know what I mean? Or not focus too much attention on. So usually when it comes to like gifts, I'll try to like categorize it differently so it doesn't say gifts, so it's not like, you know, popping into your eyes. It's all about kind of also how you present the tax return and how you label things, because something could be an office expense, something could be a gift, something could be general. Right.
I think you've told me too in the past, like I try to write off very expensive gifts, and you have told me like, we're going to take a portion of this amount. Like we can't do all of it, let's say.
Normally what I will do, and this is honestly a personal strategy, right? I'll always tell the client whenever I think something is, you know, too much. I'll tell you, like, I know you bought this $1,000 gift at Tiffany's. I know it's a gift for clients. I'm not questioning that, but the IRS may, you know, disallow that. However, I would rather forfeit that $1,000 Tiffany's gift than have them start asking me all these other questions about more detailed charges that compile a bigger deduction for us, right? So I will voluntarily give up the gifts. Right. And so to me, sometimes I'll even intentionally, not intentionally, but kind of like in a gray area, I will semi-intentionally like leave things on the return, knowing that in a worst case scenario, that will be my first to be like, here, take this. You know, in an effort to kind of be like, okay, you know what, like I caught this and I didn't realize that, you know, like here's this. Right. You know? Interesting. You gotta know how to play the game, you know? Right. It's like a little bit of a poker game.
Well, no, but I mean, one of the things I really love about you is that I do feel protected because you go to bat for your clients if they do get an audit. If they do end up getting audited, you go for them. Always. I've worked with attorneys before where pretty much like you sign when you do your taxes with them, you're like, I provided all this information to my accountant. There's no liability on them. They just put the numbers in the page the way they were given to them. And if you get audited, you're literally on your own.
I don't think that listen, honestly, at least they told you that up front, right? And that's a chance that you're taking on yourself, and that's fine, right? Because what they're basically saying is, we're giving you the flexibility to be as aggressive as you want. We're not going to question your charges.
But that's not really what you want, is it?
Some people do want that. Some people do want that. Some people will not work with me because I won't let them run amok. Which is fine by me.
And ironically, when I was giving my attorney in the past my own numbers, I wasn't writing off nearly what I could have.
No.
So yeah, like the analytical consultation that you provide that is unique to my business allows me to write off more though it might be within, you reel me in sometimes.
No, I reel in a lot. Like I don't want to give off the perception that like, oh, this is, we can do whatever we want. No.
No.
Like my whole strategy.
No,
right?
But usually you don't know that you could write off a lot of things.
No, 100%.
Yeah.
Right. No, what you don't know is I personally believe as a tax preparer, it's my job to guide you, right? I am the hands and feet driving the vehicle, but you're the GPS, right? You're telling me where you want to go, and I will drive you there as long as you're not driving us over a cliff.
Yeah.
Right? Like, as long as you're not trying to take me over a cliff, over the ocean, into the sea. Like, I'm not trying to go swimming.
Right.
You know what I mean?
Exactly.
Like, I'm not about that life, right? So to me, and ultimately, it's for that reason, because I know that in case of an audit, I'm not going to throw it back to you and say, okay, well, this is not my problem. You deal with it. I know I'm going to deal with this. And I don't want to deal with audits.
Right.
No. Like I don't want to deal with it. It's time consuming. It's tedious work. Mm-hmm. It's a lot of work for you too, by the way. Like, don't be fooled. This is more work on you than it is for me. You're the one who has to now go and organize all your receipts. You're the one who has to now go and organize your log of everywhere you drove, for the last year to rack up these 10,000 miles. Like, you have to do this work, right? So ultimately, at the end of the day, you have to also accept responsibility of, am I going to put in this work in case of an audit? Am I going to do this? And that's where I start with all my clients. Like, I will gladly, take you to the place where I know 100% we're fine, right? Like your cell phone bill, your generic stuff, whatever. Like the things that I know are 100% deductible that I'm not concerned about, those are a given, we're taking those, right? Then there's like more of like a gray area where we're talking about uniqueness to your business, like things that you're doing to grow your business that maybe other people aren't doing, that in case of an audit, we would have to explain and justify our position for why we felt this was a necessary expense, right? And most of the time, for example, like yours as a real estate, not many real estate agents have podcasts, right? But you do, and this is a legitimate form of advertisement. Right. So I have no problem being like, yeah, I understand that 90% of real estate agents don't do this, but this is a legitimate form of advertisement. It's brought us in clients. This is how we get exposure. So this is why we're doing this, and this is why we're writing it off. I very much doubt that an auditor will argue with us. Right. Argue. But then I know that when you're talking about a $2,000 Hermes gift, there will be a conversation, right? And it's my job to tell you, listen, this conversation will come up in case of an audit, and very likely you're going to get this taken away from you. So if you're fine with taking that chance now, and I'll tell you, like, this is what it's going to cost you. Right. This is what it's saving you now, and this is what it will cost you 5 years down the road if it gets taken away. Are you okay with paying that? Because everyone's very brave today until they have to pay, Oh, yeah. And audits is honestly a part of the game. Like, I could do nothing wrong, and you could do nothing wrong, and you could just be a random audit. Right. So, I mean, I do the best I can to eliminate red flags, like things that I know draw attention. Everything else, we just kind of hope that we don't get randomly picked. But if we do, okay, we do the work, and we have to be comfortable with the biggest thing for me is I want to be able to sleep. I'm 100% team player. We're doing this together. As you know, like even when we do returns, like we do it together. We Zoom, we FaceTime, like I share my screen with you. We go over everything together. I don't want any surprises or any questions later telling me that you didn't tell me about this. I didn't know you were doing this. Like, you watched me do it. You know what I mean? No, genuinely, I can definitely attest to the fact that I feel like you are absolutely incredible. 100%. Thank you. We should be cognizant of our listeners' time. We can go on literally forever. Yes. Which is amazing, but we're going to take it off camera with a cocktail. But is there anything important that we did not yet cover that we should cover quickly before we go, or are we taken care of? I feel like we took care of everything. Whenever in doubt, ask a tax preparer. Yes. Right? But you should always be working. I think the biggest thing for me, and this is like the best advice I'll give anyone, whether you're an investor, an individual with investment properties, or a business owner, if the financial team that you're working with is not giving you guidance, if they're telling you to go Google something, they're not the team for you. Yeah. So if you're working with someone that you're comfortable with answering questions, is available, giving you advice, right? Because no one expects you to know. How can I expect you to know taxes? Like, that's not your job. Right. So I have to be the one guiding you. If you're not getting that guidance, you're not working with the right team, and you're probably not saving enough money. Excellent points. Thank you, Yvette. What is the best way for people to reach you? Instagram, Yvette Sadovoy. You can shoot me an email, Yvette@savvyandsweet.com. I'm always around, or through you. Perfect. And your website is savvyandsweet.com, right? Yes. Amazing. I love the name of your company. Thank you. It's iconic. Thank you so much for being here. Thank you for having me. And thank you to our listeners. As always, you know where to find me on social, Instagram and TikTok. My handle is Christina.Kremidas. You can send me an email anytime, Christina.Kremidas@element.com, or visit my website at ChristinaKremidas.com and get in touch with me that way. Thank you so much for being here. I hope you found this episode useful, and stay tuned for the next one.